Good morning, everyone, and welcome to August Market Insights. I am Paul Nalbandian, your host for these sessions, and I am joined, as always, by my wonderful colleague, Temi Akochi. Temi the Great. Temi is always great, but that is official. Her nom de guerre for this month's session. Really excited to have you all on here with us. As I mentioned, I am Paul Nalbandian. For those of you joining for the first time or watching later, I'm an attorney licensed in the District of Columbia, but more important for these sessions, I am a real estate market expert and amateur economist. I'm licensed in Virginia, Maryland, and DC. I am a team leader on Fulcrum Residential, as is my colleague Temi. We are one of the top teams in the country and proudly affiliated with Keller Williams Capital Properties. We are going to be jumping into this shortly, but first we'll do a little introduction with Temi the Great and then talk about some coffee. Temi, would you like to introduce yourself to the folks out here?
Hello, I'm Temi.
Short and succinct as always. All right, we're going to knock you off for just a second to do, although I do have a little bit of news. I hope it doesn't disappoint anyone. We do not have a coffee of the day today. I know. We have 2 coffees of the day. Let's switch back over. All right. I think I've done Shoebox before. Today we have a Gesha from the Hachi project in Panama. Alan Hartman, Diego Bermudez, just coffee geniuses. They're just doing a lot of really exciting stuff. I've had a bunch of Hachi coffees before. So this is a Panamanian Gesha reverse protocol. They're doing lots of funky processing. And then the other one is a very well-known Colombian. It's a Maracaturra. So it's I'm probably going to butcher this. I think it's a Margot Gipe. It's a really unusual varietal I've had before, but this is a hybrid with that in a Caturra. So we're doing 2 today. 2 coffees of the day for you. These are excellent. If anyone likes light roast, incredible coffee, highly recommend Shoebox out of Chicago. All right, welcome back, Temi.
Cassie's excited about your coffee. She says you're sharing it a lot on your Instagram. She's really excited to see 2.
We're Casey, I'm gonna have to make you some coffee at some point. A little less, we've talked about a little less in-person presence for me in the brokerage offices now that I have my little girl. A little bit harder to get around, but would love to make you some coffee sometime. And thank you for joining us. I'm gonna go ahead and go on the larger screen here so I can see the comments. Good morning, Virginia. Wonderful to have our principal broker and our team leader. Casey, like I said, I'll definitely be bringing you some coffee at some point. Mark Linkowitz, our lender partner with Envoy Mortgage. Great to have you on here this morning, especially because I love to get your insight and expertise and real world, real-time data on those mortgage rates. Renee, welcome. Welcome, everybody. As you pop on, if you'd like to just mention who you are, your name, if you're an agent, if you're an industry professional, or if you're just somebody interested in real estate or the economy, if you're looking to buy a house, looking to sell a house, whatever it may be. And also, if there's anything in particular you would like to cover today, I always like this to be as tailored as possible to the needs of the industry out there and also for consumers. We're going to go through our format in just a moment. But before we start on that, now actually, have a little error I'm going to correct. I'll do that in just a minute. Let's go ahead and just run through the format for today. For those of you who have been here before, same format we generally follow. We are going to start by looking at the economy and mortgage rates. The economy impacts where mortgage rates are. We'll see where they're at, maybe where they're headed. Hit that specifically with the mortgage rates. Then we're going to go more into the economy, the various factors that impact the bond market, impact mortgage rates. We're going to talk about the conflict in Iran, still going on, still impacting a lot of things related to the economy and the real estate market. And then we're going to take a closer look at the DMV economy, unemployment rates in our area, and how that's also impacting real estate. Then we will specifically go into real estate data, looking at the DMV as a whole for the most recently reported month by Bright MLS, which is July. Then we will also look at the weekly data going into August up until just this past Sunday. So we will get as up to date as possible. Close, as always, with the key takeaways. Jenny, should we go ahead and get started?
Absolutely.
Where are mortgage rates at? So I'll tell you what's being reported by Mortgage News Daily. We'll talk about what our clients have locked at. But please share if you're an agent on here or if you're a buyer who just happened to get under contract, maybe lock a rate. Can you please let us know specifically what those rates are? It's always helpful to have real world examples. And Mark, if you could please share what your clients have been locking at over the past week. There's been a lot of volatility in the mortgage market and with mortgage rates, but we've kind of been in this 6.65 to 6.8 band for a bit. So I would be surprised to see rates. I mean, if you're an excellent, like basically excellent credit in fee simple, you might be able to get a little lower. Maybe somebody's getting a great rate in the 6.6s, but thank you, Mark. Yeah, that's kind of what I would expect, kind of 6.75 FHA and VA, a little bit low, a little bit lower. Good morning, Ty Voiles. He is here as well. He is our sponsor of Coffee of the Day. Although I think there's been a glitch in the sponsorship agreement in the payments because I've yet to be compensated for that sponsorship. But I unilaterally named him sponsor, so looking forward to that relationship as it goes forward. 5.9 VA buyer, Renee. That's a great rate. All right, so we're going to look specifically. This was as of Monday. Right now, Mortgage News Daily is reporting just a little bit lower, 3 bips, so 6.75. Like I said, we've kind of been in this tight little band here for a bit, but you can see here, I have it on the chart, little vertical bar. That was February 27th. That was the day before the first attacks on Iran took place. You can see Mortgage News Daily was reporting 599. Freddie Mac was also in the high fives. Since then, we have had a meaningful and noticeable increase in mortgage rates, and that's going to stay until this is resolved. And hopefully it will be resolved at some point. Getting into the details here, just want to say the 15-year fixed. So I think there was just a little glitch in the reporting. It's really interesting. When I pulled this up the other day, Mortgage News Daily was reporting a 6.62 on 15-year, which didn't make any sense. And I looked at it earlier today, and that was kind of gone, and they're back to reporting a 6.32, which is more in line with what we've been seeing. So all of these rates then are within 1, 2, maybe 3 bips of where we were at last month. So everything trading in this relatively small band and also matching what Mark is reporting. Renee, like I said, got that. That's 5.9. That's a really great rate for her VA buyer. Now we are going to go in the economy. If anybody would like to chime in with how they're feeling about the economy, how their clients are feeling about the economy, it's really helpful to hear what our clients, what our home buyers and home sellers are telling us about what they're seeing, what they're feeling, because it doesn't always match what is actually going on. And we've talked before, you hear a lot about a K-shaped economy, and I talk about how AI and a small group of companies are really driving GDP. So a lot of people aren't necessarily feeling that things are going so well, even though a lot of the metrics are reporting that. And our coffee sponsor, Ty, explained that the check is in the mail. I just need to check. I don't check my mail so often. So there is the glitch. Thank you, sir. So I'd love to hear people mentioning in the comments how they're feeling about the economy, how their clients are feeling, what kind of worries and concerns. Then I'm going to ever so briefly mention why I talk about the economy. Then we're going to jump into it. Not going to go in a tremendous amount of detail. If you want to go back to my January session, chapters are labeled. And at 10:21 on my January session, I go into this in a lot more detail. But just briefly, in short, I talk about the economy because the economy is what determines mortgage rates. Most mortgages are packaged into mortgage-backed securities where they are on the bond market for investors to purchase. They are competing with other bonds. And really, all investments are competing with each other for those investor dollars. So they have to be competitive. And depending on what happens with the economy, that impacts the bond market, and that will cause mortgage rates to either increase or decrease. Lately, they increased and then have been holding steady. Okay, overall economy, GDP growth. Last month, we had Q1 2026, the final estimate reported that came in at 2.1% quarterly increase. We now have the advance estimate for Q2 That is at 1.5%. That's a slowdown from where we were last quarter, but still 1.5% is a nice quarter. If we had 1.5% GDP growth every quarter, that wouldn't be bad. That would mean things were just churning along. But it's still being propped up by massive AI investment. And consumer spending also contributed a little bit. Economists are saying the consensus is that essentially with the tax cuts, there were larger tax refunds this year, and that meant more money in a lot of people's pockets, and that translated into a little bit higher consumer spending than we would have had otherwise. Now, going into the Atlanta Fed GDP model for Q3, right now they're estimating 4%, which it would be a really hot quarter. You can see here that as of late July, early August, their projection actually got up into 6%. Atlanta GDP Now model is usually hotter than other models because they don't add color. There's no human analysis. They basically have input metrics of various things about the economy that just go into this model, and it spits out a number. You can see the blue chip consensus range. That is where you have analysts assessing, looking at things, and giving a human element and assessment to the projection, and you can see those are a little bit lower. The New York Fed staff nowcast for Q3 is at 2.3. So the general expectation is probably that Q3 GDP will come in somewhere around 2. This is the exact same slide I've had for a little bit now, but just want to throw it up here because the conflict is still going on, and it is still impacting the economy and impacting our real estate market. And that's because it's leading to overly simplified, but higher oil prices equal higher gas prices, and higher everything prices that put stress on the economy, and higher inflation leads to higher Treasury yields, higher mortgage rates. And, if this continues, you're probably hard pressed not to have some kind of recession, both in the United States and globally. So how are people feeling about the economy? I asked for people to chime in how they're feeling, how their clients are feeling. I'll tell you how the American public is feeling based upon 2 surveys. I always mention they're the 2 generally considered to be the 2 most respected surveys for consumer confidence: University of Michigan survey and the Conference Board's Consumer Confidence Survey. University of Michigan consumer sentiment. So consumers are feeling worse. The August reading of 51 was an almost 8% drop from July, down 12% from a year ago. Putting this in historical context, we are not at the all-time low that we were at very recently, but still that reading, I know a reading of 51 on the University of Michigan Consumer Sentiment Survey probably doesn't mean anything to anyone outside of economists. But just to put that in context, that is in the bottom 1 percentile of index markers since the survey was created some 70 or 80 years ago. So while not at an all-time low, we are spitting distance from an all-time low. Maggie mentions that it feels like we're in a very mixed signals economy right now. Slower growth, softer labor market, but inflation is still sticky enough to keep rates unpredictable. Excuse me. And that's so true. And it's mixed signals because there are diverging things happening in the economy and different segments of the economy. And then we have the elephant in the room, which is foreign conflict, which can have a dramatic effect on things. And lately, with it being all over the place, just like, oh, we're going to have peace. We're not going to have peace. We're trying to have peace. It's now conflict is heating up again. It's just the markets are reacting to that. And it's just incredibly creating a very, very unpredictable environment, and it makes it difficult to really project in a meaningful way where things are headed, because in short, like, there are 2 very different paths. If this conflict were just kind of really ended in the short term, like legitimately conflict ended, the strait fully open to where it was before, it'll take a little while for things to return to normal. But that level of stability, oil flowing, oil rates would drop, mortgage rates would drop, the markets would love that stability. And in the relative short term, we would see a meaningful improvement in mortgage rates and in the real estate market. We would see transactions start to tick back up. Kind of, we're heading into a slower time of the year. It's not like we're going to be booming necessarily over the winter, but relative to where we would be at for the season, we would probably start outperforming last year. If the conflict gets worse or stays the same, the opposite will happen. Mortgage rates will either stay where they're at now, or if things get worse, if oil rates increase, mortgage rates will increase, and then transactions will slow down and will be even slower than we were at the same time last year. All right, jumping ahead, just touch on Consumer Conference Board. Their index is down to 89.4, down from July. It's kind of interesting. The present situation index, which is based on businesses and job market conditions, actually rose, but the expectations index fell. And so this is where it's like a lot of people still have their jobs. So they're like, well, right now, I guess I feel okay because I still have my job. I still have a roof over my head. But everything looks like, the other shoe is about to drop. I'm worried about where things are headed. And so that's also Maggie talking about the mixed signals. All right, we're going to be reporting we won't have local GDP numbers for, I think, at least a month or two. But each month we have some more updated unemployment numbers. This is the Bureau of Labor Statistics reporting unemployment for our metro area and in various segments. So DMV unemployment in June, it was up 0.1% to 5.2, but still below recent highs. It got up to 5.7 not too long ago. DC proper in July dropped to 5.9. They were 6th the prior month, recently as high as 6.7, which is good. So that employment situation is improving, but the number of jobs in DC right now has dropped by 4% over where we were at last year. So still not a rosy employment picture in the district proper. Frederick, Gaithersburg, Bethesda in June, their unemployment was up 0.1% to 3.6, but still it matches Northern Virginia for the lowest rate in the metro area and lower than the overall national rate. Northern Virginia, like I said, they are at 3.6 also. They're tied for lowest in the area, but they're up a fair amount from 2.7% last year. So with the Doge layoffs farther in the back burner, and then the federal government needing to rehire some people because they realized you can't just get rid of people without any kind of plan, and had some services that needed some staffing. So you can see that the employment picture for the area is stabilizing a little, but still not as strong as it was prior to all of that. And then these are carryovers from last month. This isn't anything new. Just want to show that Q4 GDP, we rebounded from Q4 in Q1. We have positive GDP in Q1 for all segments of the market, but things still moving a little slow, still slower than the overall economy. So it'll be interesting to see what Q2 gets reported as. Okay, Consumer Price Index. Now, this is where I have to issue a formal correction and apology. I mentioned, Temi, I was talking about last month when I was reporting the discrepancies with market stats and showing time and all of that, and how it just didn't make any sense. That my big fear was that I'm going to be running through some of this stuff and someone's going to be like, wait a minute, Paul, but this. And I'm just in my brain fog of new-ish parenting and sleep deprivation, going to be just making obvious mistakes. That is always my fear. And my fear was realized because I made a doozy of a mistake with last month's inflation number. As my daughter and I would say, when I realized this, I was just like, oopsie doopsie, my bad. So my apologies. Last month, I had reported a 0.4% gain in month over month inflation, and it was actually a 0.4% decrease. You can see that is now corrected in the chart. So we had back in June, there were expectations of conflict ending, things stabilizing, oil prices were coming down a little bit. And so we actually had a month over month decrease in the inflation. And then that popped back up to 0.1% gain here. And I'll show you in just a minute these gains. It's like they're driven by energy prices. You look at, I've said before, I've said a bunch of times, if you want to know what's happening, just shortcut is look at oil prices. And that will tell you, if you could only look at one thing and you understood where oil prices were at, watching Brent International and then the domestic index, you could pretty much project where everything else was just by that one metric. And here, going to the 12-month change, we were at 3.4%. So this was down from June's 3.5%. Things are improving just a little bit. But don't forget, before the Iran conflict, our 12 months all item CPI was at 2.4%, just very close to the Fed's benchmark of 2, although the Fed relies more on the PCE than the CPI. But still, we were right there within range of where we wanted to be. And 3.4%, we're still higher. And we're going to talk about when we go to the Fed, we are going to discuss how, in light of this, it's very likely we're going to see a rate hike in the very near future. Now, going specifically to energy prices before we move on, you can see here in this chart, excuse me, the first item in red is the all items. Then the blue is food, this kind of richer blue, maybe a grayish. That is energy. That's at 14.7%. That is the increase in energy prices over the last 12 months. And then you can see all items less food and energy is right around 2%. So it's really like there's been inflation in food. Food prices are increasing. But as I said, when you have oil prices increase, it has a cascading effect on everything else. So it's really just higher energy prices driving almost all of this now. And shelter. Shelter is also, kind of driving more under the hood. But that's more like if we had the conflict taken out of it, higher oil prices taken out of it, we would still have inflation, and a big chunk of that would be shelter. But right now, these energy costs are really just hammering everything. Okay, then as I talk about every month, because it's still a problem, how accurate are these numbers? We don't know. Definitely, probably not as accurate as they used to be, and this is because of different cell imputation. These price checkers go out. Actually, I'll just skip this. I talk about it in detail every month. We have a lot of the same folks on here, but essentially the mechanism, the tools that the Bureau of Labor Statistics uses to determine inflation, they have a lot less resources. They can verify a lot less data. And so when they can't verify actual data, they take some other data, they impute it, and then they make an assessment. And these educated guesses were at 37%. So 37% of the information that made up these CPI numbers for the most recent month were these imputations, educated guesses. Before a year ago, it was never more than 10%, always below 10%. We have been in this range of 20+% for more than a year. Okay, going to the jobs market, softening up a little bit. I think Maggie mentioned this. We lost 23,000 jobs last month. Healthcare added jobs as usual. They added 22,000 jobs, but the healthcare bump wasn't enough to support the overall job market like they've been doing recently. So jobs softening up just a little bit. And we had losses in local government education jobs, also losses in financial activities and retail trade. Unemployment rate, similar band to where it's been. It dropped a 0.1% to 4.1, where it's been kind of in this general. It looks like it's been quite the roller coaster recently, but it's more just because of how steady it's been. Even the little peaks and valleys, this has basically all been in this 4 to 4.2, 4.3 band, other than a quick pop up to 4.6 earlier. What is going on with the Federal Reserve? We'll talk about their most recent meeting, which happened right after we met last month, but I feel like I've just been talking forever. Temi, would you like to add anything from what we have discussed or about the Federal Reserve, how things are going in the economy?
I was going to say no, but the biggest thing that stuck out to me was just in kind of doing my bookkeeping and just seeing where things were last year with just my utility bills, like especially with energy bills and things like that, and seeing how it's pretty much doubled. And I'm just like, crap. I don't think I knew I could feel the pinch, but seeing how much different it was from last year to this year. So seeing that graph, I was like, I really relate to that.
Mm-hmm. Yeah, and just thankfully we're not in. You have some parts of the country where the weather is worse. I mean, here we're in a warmer time and we have air conditioning, but there in the winter where in a lot of cold places and just heating their home, the percentage of their monthly budget that fuel and heating is taking up could be really, really high, particularly this next winter if things don't get better. Okay, the Federal Reserve, they met right after we did last month. They met July 28th and 29th. They voted 9-3 to maintain rates. That wasn't a shock. Pretty much everybody expected them to maintain rates. What's more interesting out of that meeting is the 9-3 vote. Those 3 dissenting votes were voting governors who wanted to have a rate hike. And the minutes were released just last week, and it showed that even more of the Federal Reserve governors thought that we would need a rate hike, or we might need a rate hike in the future. And I have the exact quote here from the minutes. Many participants assessed that policy tightening would likely be necessary if inflation did not decline. So what that is saying is, if inflation doesn't improve, we're going to get a rate hike in September. That's what I see, and I don't see. Iran is such a, like, I mean, people's lives are being affected, so I just want to call it a mess and like just something like dismissive like that. But it's a very complex situation that does not seem like it will be resolved relatively soon. And if that is what happens, if it continues, like I would, if I was a betting person, or just to say what I expect to happen, I expect a rate hike at that September meeting. It's just, I mean, yeah, unless the jobs market just absolutely craters with these inflation numbers, it looks like we're going to see a rate hike at the next Fed meeting. And going here, we have the Federal Reserve of Atlanta's probability tracker. And right now they are saying there is an almost 70% probability of a rate hike at the next meeting, and less than 1% probability that there will be a rate cut. 10-year Treasury, it was right at the same thing. You know, talk about mortgage rates are right at where they're at, right where we were at when we met last. And if that's all you knew, you could probably make an educated guess that 10-year Treasury is also right around where it was. I'm just going to pull this up really quick. What the latest. All right, 4.668. So yeah, right in that same band. That's where the market is at right now. So the right before the Iran conflict, same thing as with mortgage rates. The 10-year Treasury was below 4%, and then it's shot up since then. Retail sales were down 0.6% in July. This was below economists' expectations. They expected a slight increase, 0.1%. And this was also the biggest drop in monthly retail sales in more than a year, going back to May of 2025. So you add that to a week jobs report, and the economy does look like it might be slowing down. And you can see from the GDP projections, that also shows it's slowing down. But these two indicators would seem to at least provide us with some level of evidence that the economy is slowing down to an even greater degree. But it's a little more complicated than that. I don't want to go into detail to make everybody fall asleep, but just want to throw something out there, and why everything is more complicated than it looks at face value, which is why just looking at the headlines, if that's all you do, you'll kind of be lost. If that's all you want to do, you can just pop in here and I'll summarize it for you. But I've talked before about how it's always tricky in April when you're comparing weeks of data, real estate wise, when you're going weekly, year over year, because Easter oftentimes falls on a different week, and that's a slower time in the real estate market. Well, this year for retail sales, last year, Amazon had their Prime Sales Day in July. This year, they had it in June. And Amazon is such a beast, and they account for such a large percent of consumer spending, that them shifting their Prime Sales Day by a month has a meaningful effect in retail sales and how much people spend. So they're big enough to move the needle. Economists estimate that if you pulled that out, then sales just would have been flat. So the Amazon switching their Prime Sales Day accounted for the entirety of the 0.6% drop. But still, you take that out and retail sales would have been stagnant. So still not showing it was very strong. Okay, then just last thing, we talked before about consumer credit card debt. Consumer credit card debt right now is around $1.26 trillion. It's just below the all-time recent high of $1.28 trillion. But that figure, that general figure, is up 60% since 2020. So consumer credit card debt is 60% higher than it was during the pandemic. And then also what's a little more troubling is that right now the 90-day plus delinquency rate is around 13%. So out of that $1.26 trillion, 13% of that is more than 90 days past due on their payments. And for context, in just a couple of years ago, that delinquency rate was at 3%. So right now, 90 plus day delinquency rate on credit card debt is at 13%. So with higher interest rates, if the job market softens even more, if people start losing their jobs, like with all of that debt, things could turn very bad in a hurry. So manufacturing. All right, 9:01. I like to try to get to real estate data by 9 o'clock, running a couple minutes behind, but I'm going to speed through this. Just want to mention that manufacturing has been doing pretty good recently. Industrial production was up 0.2%, as was manufacturing output. And so with these increases, manufacturing rose to its highest levels since 2022. And in 2022, it was having this big post-pandemic boom where a lot of things were good. Manufacturing was just really driving hard. An increase in manufacturing is really being driven by data centers and AI-related industries. That's what's causing the increase. So it's not an industry-wide phenomenon. There are a lot of sectors of industry, manufacturing, production that are hurting, but the AI-centric, the tech, is really where they're doing well. And because of that, you have a lot of companies that weren't necessarily in the space that are pivoting. Caterpillar, Ford, those are two. They're really jumping into AI and AI-related things. And then there's a company called Eaton. Eaton started out back to 1910, maybe doing truck and auto parts. They moved into electrical power and industrial systems, and now they're supplying electrical power and industrial systems for data centers. So they are kind of really doing well. Those companies that are focusing on that are supporting that industry, but those that aren't necessarily doing great. And then seeing some. Wait. Did Maggie's comment come again? Okay. Anyway, I'll just turn on. Last thing to mention before we move on to real estate data is just want to note that in case you're wondering, this increase in manufacturing has nothing to do with tariffs, like nothing in a meaningful way based upon all of the data. And that was kind of the talk that, these tariffs would protect domestic manufacturing and cause more manufacturing jobs and all of this stuff. And that's just not the case at all. This isn't related to any of that. There's actually really strong data that the tariffs hurt manufacturers more than it harmed them because it squeezed their profit margins. So the data I've seen shows that the inputs for manufacturers, what they need to buy to produce what they produce and what they manufacture, the prices on those inputs increased more than they could raise their prices on their outputs. So they actually had a profit, little contraction in their profit margin. But then just super quick. So the manufacturing rebound, the uptick in the manufacturing segment, that predated the tariffs. So that started before the tariffs were enacted. And then the recent gains, when things have heated up even more, came as tariffs were either declining or were suspended. And then also if tariffs were driving manufacturing increase, you would expect to see import substitutions. You would expect to see, okay, there's a tariff on this import. So now that segment of domestic manufacturing is now increasing, and you can see, it's just straight substitution. U.S. consumer is not wanting to pay the tariff. They are going domestically, and you're seeing that substitution. That's not happening. That's not happening. Imports and domestic production are increasing together. And then also industries least affected by tariffs, and we're talking about aerospace and computers and technology, they're the ones that are growing the fastest. So in sum, just wanted to note, nothing to do with tariffs. Okay, now let's find out what is happening in the DMV real estate market. And just Maggie, always love the comments, want to recognize that one, the credit card delinquency trend may be one of the more concerning signals. Yeah, that's something to keep an eye on, is debt delinquency. And it's hard to get up-to-date information on a lot of that stuff. But if you look at mortgage delinquency, if you look at auto loan delinquency, if you look at credit card delinquency, those are leading indicators of where things are going, because those are the first things that start to show the cracks when there are larger cracks in the economy. How are people feeling about the market? What are we seeing with our clients in July and August? Are buyers on vacation? Are things slowing down? Less properties going under contract? Or are you having a renaissance where some buyers are on the sidelines, so other buyers are trying to take advantage? I would like to hear a specific experience with the agents on here, and also Mark.
I think it may have been slower in the beginning of like August, and now it's really starting to pick up. I've definitely like heard in different masterminds of agents' businesses like slowing down, and just being funky in the beginning of August. But things are, at least I've seen things have really picked up. So yeah. But it felt like a lot of people were kind of on vacation and kind of out, and even with clients, like not a lot of things happening July, like to the beginning of August. But now with, kids being back to school, like it's starting to pick up a bit.
Thanks, Temi. Yeah, that's interesting because a lot of times, we talk about when is pro time, and you have times of the year where a lot of agents take off. And so as full-time agents who are doing most of the business, when we're focusing on servicing our clients and making sure they're taking advantage of the opportunities that might be out there, even if it's a stereotypical slower or dead time of year, it's interesting because a lot of times our business increases when the overall market is slowing down. And I think that might be what's reflected in your experience, because the data right now, we'll talk about the weekly data, like pendings are down a fair chunk over last August, and last August wasn't necessarily booming. So overall, the market is pretty slow right now, but that doesn't mean that wonderful agents like yourself and other top producers aren't doing great. And it's like, if you're thinking of buying a home, and I tell this to my clients, I was like, we may not be getting the greatest selection of homes on the market, but there are also fewer buyers out there right now. So if something good does come on, that's a bonus for us. And like this summer, been able to get some clients under contract on wonderful properties with maybe not as much competition as there might have been in the fall. Okay, talking about going up to the 30,000 foot view historical context, right now we are on pace for a little more than 50,000 units sold for the year. If this holds, it'll be the first time we top 50,000 transactions since 2022. But prior to 2022, 2022, we were at 62,000. The year before, we were at 80,000. So these are still fairly low numbers overall, which you can see in the chart, but it would be the highest number in a few years. Bright was predicting we'd hit 54,000 units this year. If the Iran conflict continues, we're not going to hit that. I just see no way we are going to hit that, because we are trending down. We are trending at a lower level of transactions right now than we have had in the previous year, or at least stagnant. But if that resolves, we could see a nice little rebound. And Mark is saying that he's experienced a little more traffic at the end of the month. But Mark also works with a lot of top producers, so it might be the same kind of thing. But it'll be interesting to see what carries over in a meaningful way market-wide, very end of August into September. Now on to DMV median sales price. There are a few things. There's a lot of volatility, a lot of unpredictable elements of the real estate market. But one of the things that you've been able to just pin your cap on or something, I'm getting the little metaphors and comparisons mixed up, but median sales price increases DMV wide. That is something that has been as steady as you could possibly be over the last 38 months. Every single month, year over year, we have had a DMV wide median price increase. 38 straight months of median sales price appreciation. The last time we didn't have higher median sales price DMV wide was June of 2024. And the median sales price was up 1.6% year over year. Median days on market, exact same number as last July. We were at 15 for that. So that's been holding steady. Another thing we've been seeing is an increasing number of days on market for a lot of months recently. That didn't happen in July, but I'd like to note that 15 is tied for the most July days on market in the past 10 years. We had that happen last year. July was at 15 days on market. And then in 2017, it was at 15 days on market. But the three highest days on market for July in the past 10 years. So it's like homes are taking a little longer to sell in July than they normally do, but still a vibrant market. Still, more than half of homes going under contract in around 2 weeks or less. Looking specifically at closed sales and new pendings, closed sales were even from last year in July, which is right around where you would expect. Pendings last month were down 0.7%, so we knew closed sales would be right around in that same band. Pendings, though, were down pretty big through this month, down 4.2%. That's the fewest pendings DMV-wide in at least 10 years. and 68% of 2019 levels. So that's a really, really low pending level for July. Mentioned year to date, though, closed sales are up about 2% over last year and pendings are up about 2.7%. But with this, if this slowdown continues, those numbers aren't going to hold up. New listings have been a bit of a roller coaster lately. They're kind of up and down, up and down, up and down. They've been back to up now for the second straight month, up 3.3% year over year. And active inventory, this is another thing. If somebody just asked you to make projections about what would be happening next month in the real estate market, if you wanted to be safe, you could say median sales price will likely increase and active inventory will likely increase. We have now had 30 straight months of monthly year-over-year increases in DMV-wide inventory. So slowly, inventory has been increasing and increasing and increasing. And it's still, like you can see here, the orange bar there, we're at the high end of the past 5 years. And we're finally starting to get above those kind of normal 2018, 2019 levels in some segments. And we're going to talk about that in more detail when we get to the county breakdown. Everything we've talked about, a little bit more details from the past month in the deck. You want to take a closer look? Now we are going to look at county-specific data. So median sales price. Median sales price is up overall and in Northern Virginia. So up 7.4% in Loudoun. You consider Loudoun part of Northern Virginia as far as Nova core, but up in Arlington, up in Alexandria, up 2.5% in Frederick, pretty close to even in Montgomery County, and DC down 1.2% in Fairfax. See a huge double-digit jump in Arlington, which is like, okay, everybody knows real property value did not increase by 16% in a year in Arlington. It did like property values is an absolute kind of thing, didn't increase by that much. So I wanted to take a closer look. And in Arlington, oftentimes it is property type distribution. And so here you can see that bar on the right is the sales of $2.5 million to $5 million homes, the year over year change. So you can see there were a lot more sales in July in Arlington of $2.5 to $5 million homes. And then everything else is the lower priced homes, which were either right around the same level they were at last July or lower. And so just, I know you can't see the numbers on here, but this July, there were 14 sales in Arlington of $2.5 to $5 million homes. Last year, there were 4 sales. And so that's what's driving that, and the fact that all other sales, all other price points were either the same or lower. That's what drove that 15.8, 15.9% increase. So Ty asked, interesting that inventory and median sales price keep going up while median days on market remains pretty flat. So median days on market it's flat for July, but median days on market have been steadily increasing throughout the DMV overall. And homes are still taking longer to sell, but it's an interesting thing when we look at comparisons of where things are at and where they've been. And we live in an area that is generally a very competitive real estate market. We don't have a lot of just vacant land where things can be built, or in areas, where you could build, where otherwise you could build condos. For zoning or various reasons, you can't necessarily add higher density housing. So because supply is inherently constrained here, we have situations where, like now, it's just inventory is steadily increasing, days on market are creeping up, but inventory is still really low, all things considered, and days on market are still really low, all things considered. And so we're seeing, like, in the absorption rates and months of inventory, those have been pretty steady throughout, and we'll jump on that a little bit closer. But this is fascinating, like appreciating the questions in the comments, because this stuff, it's like there's a lot of things happening that doesn't necessarily make sense on face value, or it doesn't make sense at face value unless you really understand what is going on. And that's why, in addition to saying, oh, this is the change, I also like to add overall context, because while inventory has been increasing, it just regularly, it's still, inventory is still low pretty much across the board outside of DC. Casey, appreciate the contributions there. Casey talks about how from realtors she's talking to, and she talks with a lot because she's the team leader at KWCP. Listings are difficult to move right now. Business is slowed with concerns of carrying that inventory. Yeah, and expense. Yeah. And price is 90% of the marketing. It is. One of my key takeaways is still like, yeah, it's a seller's market outside of DC, but it is still really important to price a property appropriately. Okay, now we're moving on to closed sales. So last month, closed sales were up everywhere except Northern Virginia, Arlington, and Alexandria. Different story this year. Closed sales were up big, 17.3% in Frederick, then close to even in Fairfax, Loudoun, Montgomery County, and DC, down 1.6%. In Prince George's County, down 2.3% in Alexandria, and down 5% in Arlington. And with Frederick just being such an outlier, want to take a closer look. A lot of times, new construction is really moving the needle in Frederick. Not so in July. There were 374 closed sales in Frederick in July total. Only 23 of those were new construction. Going to new pendings. So new pendings down really big in Alexandria, 32%. They were down 7 to 8% in Arlington, Loudoun, and DC, down 4% in Montgomery County, 2.3% in Fairfax, up 2.1% in Prince George's County, and up almost 9% in Frederick. So back to Alexandria for a minute. Like, this is a real and meaningful decline in pendings. And it's not just that last July was really hot in Alexandria, and so by comparison, it's doing less. That's just a really, really low number of pendings in Alexandria for July. And for context, the 119 pendings in July were the lowest number of pendings in Alexandria for any month outside of December in the past decade. So other than December, which is usually the slowest month, least amount of pendings in Alexandria, other than December, this July number is the lowest amount of properties that went under contract in Alexandria in a decade. Okay, showing level, not a surprise. This pretty much matches. You look at the pendings, you look at the showing level, and they usually track each other within a little bit there. Okay, new listings. Now, this also follows what we've been seeing for a bit. New listings are up everywhere. Here, they're up everywhere except Loudoun County, where they're basically even. They're down 3.4% in Alexandria and down 8.3% in the district. And the district has seen lower levels of listings lately. Looking at active listings, and I'm going to give some historical context because I've been saying a lot of times inventory is increasing, but we're still kind of not at normal levels. Mentioned before, we're getting a little closer to those normal levels. So active listings up everywhere except for DC. DC's down 4%. They're up 8.5% in Loudoun. Everywhere else, active inventory was up more than 10%. Fairfax more than 20%, and Alexandria more than 30%. So to add just historical context, so right for Alexandria, first time in about 8 years that they've had 400 or more active listings at the end of a month. And then Arlington, first time since September of 2021, they've had more than 475 active listings. Now this, I'm not talking about monthly year over year. I'm saying Alexandria, this is the first time in about 8 years at any month they have had that level of active inventory. And I'm going to go through each of them and comparing the same thing. So Fairfax, first time in about 7 years since September of 2019, the Fairfax has had 2,000 or more active listings at the end of a month. Frederick, first time in 6.5 years since January of 2020, they've had 750 or more active listings at the end of a month. Loudoun, first time they've hit this level since October of 2019. Montgomery County has had more than 2,000 listings, 2,000 active listings at the end of the month for 3 straight months. But prior to these 3 months, that's the first time they were above 2,000 since October of 2019. And then Prince George's County, they've had more than 2,000 listings for the past 2 months. But prior to these 2 months, they weren't above 2,000 active listings at the end of any month since November of 2018. And then Washington, D.C. is the only outlier. They have had elevated inventory for quite some time. This 2,600, 2,630 listings. They've been above 2,500 active listings for most of the past year. So their inventory has been higher relative to the region. But you can see now these other areas are catching up But just a little bit more context when I'm talking about highest numbers since 2018, 2019, that just means that inventory is returning to kind of these normal levels for the area. It's still relative, and we're going to talk about months of supply. It's still low inventory, but at least it's getting a little closer to what we traditionally have, which got really skewed with the pandemic and then these unnaturally low interest rates. Now, here we go. Ty was talking about absorption, months of supply. This is pretty similar to where we've been at. And it's like outside of DC, there's still not much inventory. If you look at this objectively, by definition, DC has 5 months of inventory. You can call that pretty much equilibrium, not a buyer's market, not a seller's market, even though it feels like a buyer's market in DC. Prince George's County, a little bit more than 3 months of inventory. Everywhere else, 2 months or less of inventory. That's just not a lot of inventory. And yeah, the and Ty, so this is what I find fascinating about, inventory is creeping up and buyer demand is staying kind of soft-ish. But if the conflict in Iran ends and mortgage rates drop, it'll take a little while for there to be serious movement. But if we get back to where we were beforehand and rates start creeping into the fives, then I think we're going to see buyer demand really pop up a bit, and we might see some of these inventory levels decreasing. And yeah, Casey, that's interesting. Median sales price holding, because I believe sellers prefer sit unsold rather than slash prices. Yeah, and this market's interesting. It's usually, you say, if a property's not selling, it's because of price. But there are a lot of really great properties priced well that aren't selling because there just aren't the buyers out there, or it's a smaller segment of the market and there are more listings hitting that segment than usual, and there's just not enough buyers to absorb that in that particular segment. Okay, median days on market. Median days on market, similar pattern, longer in DC and Prince George's County, and a fair amount less everywhere else. In July, DC, Prince George's County, both around 3 weeks of median days on market. Everywhere else, 12 days or less. So, like, put it in context. Yes, inventory is increasing. It's been increasing for quite a while, but in many segments of the market, half or a little more than half of all homes are going under contract in about a week. And in all of the market outside of Prince George's County and DC, half or more than half are going under contract in less than 2 weeks. Okay, now on to the weekly data. And so this is what I was talking about, where we're seeing a slowdown continuing into August. And I'm going to be popping around to these slides just so you can see them. I'll be going back and forth. Hopefully, hopefully it's not nauseating, just going back and forth and there's not a lag. But you can see, so new pendings for the first 3 weeks of August, new pendings were down 7.5%, 15.5%, and 8%. So almost certainly we are going to have a much slower month of August than we did last year. And, as long as this conflict continues, we're going to continue seeing this. I think we're going to continue seeing a meaningfully slower real estate market than we saw last year if the conflict continues, oil prices remain elevated, and mortgage rates remain elevated. New listings up overall for the month, but down weekly. So it was up 7%, down 4.4%, and up 10%. So overall, more new listings. I expect that to continue through the last week here, and overall for August, expect to see more listings than we had the prior. Showings down, matching the pendings. Showings were down each of the first 3 weeks, as you would expect. Median time to contract was within 1 day of last year's numbers. And then active listings, no surprise, continuing the trend we've had. Higher active listings each week, and those go up 12%, 13.8%, 14%. So 12 to 14% more active listings there. Before we hit the key takeaways, got 5 minutes left. Temi, your thoughts. What are your clients seeing? What are everyone out there? What, in light of, did anything surprise you that I shared? Did you disagree with anything I said?
Honestly, a lot. Sometimes in several months, when you're talking about things, it just kind of realigns what I'm already seeing, and not only what you were saying, but then also what I was seeing in the comment section about listings just kind of sitting, and then also what Casey was saying about the sellers. Like, I have a tremendous amount of listings, but really, what's really kind of moving forward right now are my buyers, and over communicating with them to get the offers in, especially when they like the home. And that's really been where my under contracts have been coming from. And the listings are just kind of sitting there. As you know, sometimes sellers are dropping the price, and competing with other sellers who are dropping the price when your seller doesn't want to is tough. But I think I put up 6 listings in the last 2 weeks, and the ones that are underpriced are moving. The ones that are fair market value are sitting.
Mm-hmm. Which is tough. It's a challenging situation when I would guess, I know this is what I'm experiencing a lot. The market, a lot of those sellers purchased those homes in was much more competitive than it is now. So sometimes their only frame of reference is like, wait a minute, when I bought this house, we competed with 6 other people and it was under contract in a day. So yeah, communication and over communicating, I don't think you can have, as long as you're adding value and insight, I don't think you can have too much communication, particularly in a time like now where there's just a lot of uncertainty all around.
Yeah, and I think it's tough. We're seeing a lot more expired listings. I'm getting listings from people who were previously listed, and I'm learning to over communicate with sellers, and that there isn't. You can't over communicate really, but I'm learning that how important communication is, especially as things shift, and just strategies. Communicating different strategies to sellers. We're getting a few more comments in.
Yeah, thank you for sharing that, Maggie. It is difficult when you have mortgage rates that had started, still historically, like I think the historical average of mortgage rates is right around 6%. So a little higher than that, but in the range of decent, definitely not like this predated all of our careers probably, but the savings and loan crisis, or when mortgage rates were at 17% or whatever they were. But it is, with a lot of uncertainty happening, mortgage rates creeping back up from their recent lows. Sometimes buyers just don't have confidence in their own opinions, and they need our reassurance that it is a good time to buy, or what they're feeling in their gut or what their mind is telling them is in fact a sound decision. And they are. And Mark talks about a lot of great opportunities for buyers out there if they're willing to look for it and take on the rate right now. And it is, if the rate drops a meaningful amount, there will be a lot more competition. And the fact that you can refinance, and a lot of like Envoy and Mark offer a special refinance rate where they take away a lot of the fees. I mean, there's still some things you have to pay just by law, but relatively cheap refinance. And so to be able to get a property, we've talked about 38 straight months of median sales price increases. So property prices just keep increasing. And so if you're able to purchase now, then when rates go down, you can refinance, but you were able to build all of that equity in that time. That's still great value. And that's, Temi, can you take the comment down just so we can see the full takeaways? And that's one of my takeaways. Like, buyers continue to have more choices, less competition, and more negotiating power. So inventory is really, we're finally meeting or exceeding a lot of those pre-pandemic levels. And a lot of buyers remain sidelined by mortgage rates. So for the buyers out there, it's really, really a great time to buy. One of the better times to buy, putting mortgage rates to the side for a moment, one of the better times to buy in years, I would say. So just going back to the top now, key takeaways in the world. Conflict in Iran is still throwing a wrench into everything. If you want a shortcut to what's happening, how things are going, just keep an eye on oil prices. I've been saying that for a while now. It's true. It was true then. It is very true now. Real estate overall, as we've said, inventory is finally back to 2019 quote unquote normal levels or higher in many areas, but buyer demand is a little weaker than it has been. Higher mortgage rates are slowing the market, but without turning it into a buyer's market. It's not a true buyer's market anywhere, except you could argue DC. I'd say that's more an even market. but it's still a much more advantageous situation for buyers than it has been. Agents, I used this exact same line a couple months ago that Maggie called before I even pulled it up. Be the interpreter, not the reporter. The market has so many conflicting signals. You really need, agents need to be able to explain those to clients, because if as industry professionals, we're struggling a little bit with what's happening, then almost certainly our clients are struggling as well. So you really need to be able to explain what this data means for them. If you just went to someone and said, "Oh my gosh, inventory has been increasing, every month for the last 3 years," you would probably give them a different picture than if you told them, excuse me, the months of inventory, in what that means as far as the equilibrium in the buyer-sellers market. Buyers, we already talked about them, so we're just going to move on to sellers. More inventory doesn't mean a buyer's market. Still a strong seller's market outside of DC and Prince George's County, but buyers are more selective. And as Temi has shared, other people have shared on here, some homes are sitting longer. So it is very, very important. Condition matters. Condition matters. Very important to present a property in the proper condition, price appropriately. And then even then, just anytime you shrink the reps, you kind of shrink the size of a pool, it's not always necessarily going to end up how the odds should say it would. And so you do have a lot of great properties that are priced well or in great condition, but there's just not the buyer pool out there for it right now, and they're taking just a bit longer. This is my contact information. I'm not going to leave it up here for too long, but if you want to get a copy of the deck, you can just shoot me an email. I can add you to the list. You can rewatch. This will be posted up on YouTube a little bit later. Let's go back to the 2-shot. Oh, 2 minutes over. I thought my internal clock betrayed me. I thought really felt like 9:29 or 9:30 to me. Thank you, Maggie. Appreciate you joining, your contribution. Thank you, everyone, for joining us. Temi, any closing thoughts before we wrap for August?
No.
Wonderful. All right. Thank you all for joining us. If you're watching this later, if you have any questions or curious about anything, want some additional information, you can just throw it in the comments and I will reply to you there. All right. Take care. Enjoy the rest of your summer and these really nice weather days, at least in the DMV.